Hello, everybody. Ed Yardeni here. It's September 8th, and time flies when you're having fun. And aren't we having fun? It's been a crazy, wild year. And despite everything that's been going on, we basically have the stock market at a record high or close to its recent record high. Bond yields are coming down, and life is good. The economy has been performing relatively well. I guess today we'll get an Atlanta Fed update on what real GDP is doing during the third quarter. It had been running around 3% with Friday's employment report on the disappointing side. That will be likely revised down, maybe down to 2.5%, but that's still pretty good. And while the consumer number may be weaker as a result of what we saw on the report on Friday, capital spending is holding up extremely well. And so we'll see how it all plays out. But right now, nobody's really particularly concerned about a recession. We have the poly market recession bet showing that only 8% of those playing the game thought that there'd be a recession in 2025. Of course, 2025 is just about over. So we're waiting to see if Poly Markets does one for 2026. They may or may not. If the perceived if the perceptions of a recession remain very low, they may decide it's not worth setting it up as a bet. But we'll see. I'm sure there will be a recession in 2026, but it may not be a bet until January or February. But we do follow that indicator, and it suggests that recession concerns were not raised to any extent by the weak numbers on Friday. The Friday numbers were certainly weaker than we thought. We were looking for 100,000. I think Goldman was looking for 66,000. I think a lot of people were around 65,000. Instead, it came in at 22,000, and that was for August. July, I think it was revised to a negative number. But all in all, over the past 3 months, we've had a very weak pace of payroll employment. But we've also had a crazy labor market, a lot of moving parts there. For one thing, the southern border has been effectively closed. We are now seeing quite a bit of deportations of workers. And of course, psychologically speaking, if you're thinking about coming to the United States through the southern border, well, you're not thinking about that anymore, because even if you were able to get in, you probably would get deported, and that wouldn't be much fun for all the effort you'd put in. If you're already here and you don't have the proper documentation, if you're basically illegal, then you might self-deport rather than going through all the anxiety of having ICE or somebody come to wherever you're working. And of course, there is the actual deportations going on. So the supply of foreign workers, let's put it this way, the supply of foreign-born workers, that's what we have data on for the labor force. That's down 1.5 million from March to June. Obviously, that has had a lot to do. Sorry, let's do that again. It's up 1.5 million from March through August. And so that's a significant decline. I don't think I don't think there's any seasonal factors in this particular data set, but it does suggest that the labor force has been weak. The growth rate's been very weak in recent months, and to a large extent because foreign-born workers are dropping out of the labor force, dropping out of the population figures as well, suggesting that one way or the other, they are leaving. So employers clearly are going to have major second thoughts about hiring anybody who doesn't have documentation. And no point in training somebody to do a job if ICE is going to come in and raid your factory. And we just saw an example of that, very visible example with Hyundai. They have a battery plant in Georgia, and they were raided by ICE on Thursday of last week. And as a result of that, 450 workers, maybe not all 450, not all of them were South Koreans, but the South Koreans are going to be put on a plane. Maybe they've been put on a plane this morning, and will be flown back to South Korea. That's really complicating things in terms of trying to understand what's going on in the labor market. I think there clearly is a supply issue. I think there's also an issue of AI, artificial intelligence. So far, I think the reviews are kind of mixed on whether AI is really getting adopted and making a big difference to productivity. I think there's a lot of companies that are just trying to figure it out and decide whether it's going to be a game changer for them. And maybe they've decided that while they're figuring that out, why increase your payrolls? Let's first see whether there's some real potential here for AI to make a difference. If nothing else, to increase the productivity of your current labor force. You don't have to fire anybody. You can just make them more productive. If you make them more productive, their unit labor costs to you are down, and they are profitable. No point in firing workers who have been with you for a while, workers that you've trained. And so we're not seeing much at all in the way of layoffs, and we continue to watch that in initial unemployment claims, which week after week remain under 250,000. We're also watching continuing unemployment claims as a good indicator of the duration of unemployment. And that's really what's changed in the labor market, among many things. One of the things that's changed is the duration of unemployment has increased. There are more people that are searching for jobs and having trouble finding jobs, so it's taking them longer to find jobs. And as a result of that, there are more people that are actually no longer getting continuing claims. So it's conceivable that uh, well, so we've got again some mixed pictures here. We got people that have been getting claims, continuing claims for 26 weeks. Then in the 27th week, they fall out of that and they're on their own. And obviously, the duration of unemployment takes them into an area where they're no longer getting support, and that could weaken some consumers. Obviously, they're not getting support from unemployment claims and on their own. So that's where the weakness seems to be on the demand side. Employers aren't rushing to hire the people that are unemployed. A lot of it seems to be teenagers. The unemployment rate for them, I think, is like around 13%. A lot of that is for people who are 20 to 24, so a lot of them are recent college grads. But then you also have to figure that the teenagers and the 20, 24-year-olds may very well be young people who crossed the border illegally and now are either leaving on their own or going back or being sent through deportation, or they're not being hired and they realize that there's no opportunities. So they're basically out of the labor force. Our thinking is that as a result of all this, as a result of the retiring baby boomers, the slowdown in the supply of labor, well, we don't really need to have as much demand in order to keep the unemployment rate down around 4%. Right now it's 4.3%. But as weak as the payroll employment numbers have been for the past few months, what's fascinating is that the unemployment rate has remained low. So economists like myself and others are starting to talk about the possibility that the break-even payroll gains that we need to keep the labor market around full employment, around 4%, is no longer 150 to 200,000, which was kind of what we all got used to expecting would be a decent, good number. If we got under 150, we kind of got disappointed that the labor market was weak. But in the current situation, we may have I mean, the data is suggesting that something between 30 and 50,000 may be enough to keep the unemployment rate at full employment around 4%. My hunch is it's probably more like 60,000. Nobody really knows, and I guess after a few more months, we'll get some better sense of it. If the numbers continue to remain around, I don't know, 30 to 60,000 per month, and the unemployment rate remains around 4 to 4.3%, then I think we can conclude that, yeah, we don't need as much demand for labor. The problem is, of course, is what does all that mean for the economy? Right now, the economy is doing fine. It was weak in the first quarter for a number of reasons, probably related to the policy shocks of Doge and tariffs and all that. But it rebounded smartly in the second quarter, and I think it's going to hold on to a gain of at least 2% in the third quarter. And in both the second and third quarters, the employment numbers have been weak. We did see a substantial increase in productivity in the second quarter, admittedly after a drop in the first quarter, but productivity was revised up, I think, from 2.2% to 3.3%. It's in the morning briefing, so don't quote me directly, but have a look there if you want to see the numbers. But it was revised significantly. Unit labor cost inflation was revised down, which is good for the long-term outlook for inflation. Real wages are increasing by over 2% if you look at real hourly compensation in the second quarter. And now, if the economy continues to demonstrate demand from capital spending, if the consumer hangs in there as we think they will, then that would say that the demand for goods and services is good, is doing fine. Real GDP is doing fine, but the labor force is weak. So the good news is it implies that productivity is doing what we've been expecting it to do during the roaring 2020s, and that is to grow at a faster and faster pace. And so if you got a real shortage of workers in the labor force, people, foreign-born workers that you relied on are leaving. Maybe AI replaces young entrants into the labor markets. You're increasingly going to be thinking about focusing on technology, on productivity, on simply better management of your resources to increase productivity. And so the good news in the bad news on payroll employment may actually be that it's an indication of a labor market that's still in equilibrium. Supply equals demand. We've shown you that chart that Jay Powell introduced a while ago. It's a very clever chart, and it showed that supply equals demand in the labor market. And at the same time, if that's the case, then maybe the bad news in the labor market isn't really that bad, and it's really being offset by productivity. Because obviously, you know, if supply equals demand, but that means you're getting lower increases in payroll employment, aren't we going to run out of consumer spending? And the answer is not necessarily, because income is dependent not just on the number of people working, but it's also dependent on the real wage. And the number of people working every month on an incremental basis, it has been growing. But what really makes a big difference, of course, is real wages, because real wages affects everybody that's working, not just new workers on the margin. So I'm still believe in the roaring 2020 scenario. I think it's worked out pretty well so far in the stock market. Let me just should have anyhows. So that's kind of my spin on the employment report. Now, meanwhile, the stock market's pretty much behaving as we thought. We're still using 6,600 by year end, but I want to show you there's some interesting things happening on the earnings side. You know, we've been talking about a potential meltup if the Fed goes ahead and cuts rates, is now expected by everybody. 100% is the CME Fed Watch tool. I don't know. We're being stubborn and contrary. We raise it from 40 to 80% after the payroll employment numbers. And we're still, like everybody else, kind of wanting to see what happens with the PPI and CPI in the next few days. It looks like the CPI is going to be up 0.3%, according to the nowflation model that the Cleveland Fed runs. And that's not terrible, but it's still up over 3% on a year-over-year basis for the core. There we go. Sorry about that. So with some sort of little glitch in our production here. I hope you don't mind. And as you can see, Max doesn't mind much of anything. Gave him a little blanket to lie on, and he kind of likes it. So Where are we? So I want to show you some charts here that we may actually be having an earnings-led melt-up. The earnings picture is really remarkable. If the economy is not doing well, if all this weak employment numbers implies that consumers are in bad shape, why aren't we seeing that in the employment in the earnings numbers? And the profit margin seems to be actually holding up remarkably well according to the data we look at, which suggests again that productivity must be making a comeback because all these tariffs that have been imposed are raising quite a bit of money, and that implies that costs of doing business are going up, and yet one way or another the profit margin's holding up, revenues are holding up, and earnings are holding up. And the only surprise that we see is that they're better than we expected, and we've been among the bulls on earnings. Well, without further ado, let's go look at some charts. Now all we got to do is make sure that I find them, and sure enough, I did. Last week I kind of fumbled around trying to find them and gave up, but this time I rehearsed a little bit more. So here we go. Here's the charts. And I started out accentuating the positives in today's report. I figure you can use it. I'm sure you're getting quite a few reports about how terrible the employment report was and all the dire consequences. At least I would expect so. So here's the poly markets recession expectations from their betting market. And you can see that that's come down dramatically. And even on Friday, with that payroll employment report, the recession bets were only 8%. When we look at the Atlanta Fed's model, I have to believe it might have come out. I'm looking at my email. I don't see it out yet. Maybe it'll come out shortly. But this is what it was before the employment report. And you can see that the expectations was 3%. I would expect that that'll be revised down to something like more like 2.5%. But it seems to me that nothing happened on Friday that takes away from the outlook for the rest of the economy. It looks like fixed business equipment is doing extremely well, according to the Atlanta Fed model. Exports of goods, surprisingly well. Imports of services, of course, suggests that the U.S. economy is doing well, but that's actually a negative for GDP. Exports are a positive again, a solid positive. Intellectual properties and capital spending, that's strong. So a lot of these aren't going to change. What might change is maybe the PCE. Maybe that'll be weaker than 2.1%, maybe 1.5%. Goods might be somewhat weaker. The government, well, the Doge has had some impact on government employment, and we're seeing it in the payroll employment numbers, and that in turn is affecting maybe government spending. State and local government spending has been particularly weak, and that actually has some bearing again on the foreign-born workers story. If state and local governments now suddenly have to spend less on teachers and less on social assistance from the flood of migrants that came in during the Biden years, that's actually weighing on payroll employment. And by the way, if that's the case, if the Fed lowers interest rates, I guess it is an if, but when the Fed lowers interest rates on September 17th, what difference is that going to make to hiring teachers and social workers to work with migrants that are getting deported and aren't coming in? So that's something to consider is even if the Fed lowers rates, is that really going to change the labor market dynamics? Meanwhile, you would think that with the weakness in employment and the downward revisions, that retail sales will be showing that. And we did see that the retail sales ex food services in July were up decent, 3.7%. Some of that might have been pricing, but not all of it. And then, of course, the Red Book retail sales number, which we look at, it's a weekly number. As you can see, that was up solidly at 6.5%. This is our earned income proxy. It's total hours worked, so it reflects payrolls and the number of hours worked during the week. times average weekly earnings. So it's basically total hours worked times the wage rate. And total hours worked were flat. The average hours worked during the week was flat. The payroll increase was basically flat. And so the earned income proxy increased by 0.3% month over month, which is exactly what the earned income proxy is going to do. So that could be offset by inflation, 0.3. So that might be a flat line for the month in the real income. That could potentially weigh on retail sales, but a lot of the consumption is now widely recognized is being attributable to wealthier upper income people. But even using that phrase isn't quite correct because a lot of it is baby boomers who are retiring, so they don't have incomes anymore. To the extent they're retiring, they might have interest income, dividend income, but they no longer have labor income, but they have a lot of net worth. Baby boomers, as we discussed before, have $80 trillion in net worth, and they're trying to spend it, but the stock market keeps going up, and their net worth seems to be going up faster than they can spend it, and that's a great situation to be in. So again, not only is it a complex labor market, it's also a complex consumption market. This is interesting. We are big fans of seeing what the analysts are saying and comparing their consensus to actual results. This is S&P 500 retail composite forward revenues. So we update that every single week. And look at this. As the retailers reported, and the stocks obviously went up, the the revenues picture picked up, as did the earnings picture. So where's, I mean, back here you had, granted it kind of increased until, and then decreased late in the recession. Here it took a little while into the recession. So maybe this thing is about to roll over, and that's what I'm missing. But for now, it looks like this is sending a positive signal on retailers. Car sales, they're kind of like stuck in neutral, but at a pretty decent pace. 16.1 million units is certainly not a level that suggests that consumers are hunkering down in any fashion whatsoever. And I think 80% of auto sales now are the domestic and foreign light trucks, and they're expensive. They're expensive to buy, they're expensive to insure, expensive to maintain. And so there's a lot of people out there that aren't put off by that and are buying these things. Productivity, I mentioned, is doing very well. 3.3% was the increase. That followed a decrease, but that was a stronger reversal. And now we'll see where we go from here. But our roaring 2020 scenario, things have worked out reasonably well on the productivity side in the first half of the year. We expecting to see more of the same, if not more productivity growth than we've had in the second half of the decade, particularly if we're talking about shortages of workers that mean that if their demand is still pretty good, if the consumer hangs in there, the baby boomers continue to spend, capital spending on technology continues to do well, and you have to spend on technology in order to offset shortage of labor, then that all kind of works to, it all logically connects to a positive scenario. Meanwhile, just by the way, this is a pretty volatile series, Citigroup Economic Surprise Index. It does have some relevance to the bond market, but you'll notice that even with Friday's employment report, it still remained pretty decent with a positive reading at 20.1. So I'm not quite sure how they calculate these things. I don't know if they, change things based for revisions. I don't know what kind of weighting they give this thing. It seems like it's one of these Coca-Cola recipes where we don't really have any way of knowing how it's conducted. But I think this is kind of interesting. Okay, so here's what I was getting at. Look at this. This is revenue expectations for 2025 and 2026 on the part of analysts. And as you can see, they got spooked here. Trump came in and started talking about tariffs, Doge, and all that. So they lower their revenues expectations for both years. And then Liberation Day came. I think that was around here. And then following Liberation Day, a few days later, Trump postponed that. And then everybody started to, anyways, rethink the whole thing about, how big how damaging was this going to be? And they talked to the companies. They listened to the guidance for the first and second quarters. And look at here, we got revenues basically going up here and here. And when you combine them into the time-weighted average of this and that, you get forward revenues. Forward revenues, all-time record high. That's impressive. Got some more stuff to impress you with. This is the S&P 500 operating earnings per share. Again, look, same kind of psychology in terms of analyst expectations. Part of that was, of course, the first quarter turned out to be much better than expected, and then the second quarters turned out to be much better than expected. And in the first quarter, companies really didn't give guidance. They said we can't give it, but they gave great earnings. And then in the second quarter, they gave great earnings and maybe some more positive guidance than they gave in the first quarter. And look at this forward earnings, all-time record high. And by the way, this correlates really nicely as a cyclical business cycle indicator with things like the index of coincident economic indicators with payroll employment. I mean, clearly, profitable companies hire people, unprofitable companies fire people. Well, nobody's firing, so companies are still profitable. Maybe they're just not hiring. And by the way, that's a bit of a myth. I covered it in the quick takes of that just a few days ago. I said the notion that it's a no hire, no fire economy is just wrong. The fact of the matter is during, let's see, I guess it was July data is what we have for JOLTS. The July JOLTS data showed that over 5 million people were hired during the month, but 5 million people were separated either through quits or layoffs, and a lot of that had to do with quits. Again, labor market's in equilibrium. Companies are hiring, but the separations are about the same, so we're not on balance seeing an increase, much of an increase in employment. Now, this is another impressive chart, I think. This is the profit margin. This is analyst consensus expectations for the profit margin, and they stopped lowering it for 2026 at a rate of 14%. It'd be nice if we get there. We're actually closer to 13%, and you can see that's where this year is tracking at, and that started to go up. And so the forward profit margin is going up. So in this data, it's hard to see that there's any real problems in the economy. And I asked Joe, I said, Joe Abbott, my colleague, I said, can we have a chart of where the surprises are, what the analyst consensus expectations were for the by quarter. So let's look at the second quarter of 2025. The data just came out, and you can see that this is kind of going into the quarter. And then once they got the actual results, the surprises were mostly to the positive side. Big positive on communication services, information technology, financials, healthcare, and so on. Here's another Joe Abbott creative chart. Asked them to do 3-month percent change in forward revenues. Look at that, straight up. Everybody kind of get used to the tariffs. They were postponed. We saw that companies got back to the analysts and said, we can deal with it. We can deal with the labor market issues. And then look at earnings, positive forward earnings surprises. Boom, not surprises, analyst expectations. Another happy chart I want to show you is, I tend to be a glass half full kind of fellow. I figure enough people are telling you the glass is half empty. But look at this. This is kind of puzzling, isn't it? 470,000 applications, not seasonally adjusted, monthly rate. 470,000 applications to start a business. And that's pretty good. I mean, I think you have to go back to 2022 to, when we had a lot of people saying, well, I'm not going to go back to my job. I'm going to start my own business. We had a lot of job creation, business creation here, and here they're doing it again. And that's pretty remarkable. And again, if once the application is filed and you start the business and you start paying a payroll to yourself, if nobody else, isn't that 470,000 people that just got a job. Again, maybe with a little bit of a lag. Maybe the birth-death model that is in the payroll data isn't showing enough. Meanwhile, tomorrow we're probably going to get a downer. We're going to get the benchmark revision for I think the period is from about March to January. There'll be March of last year to February of January this year. We're going to get a kind of a revised version of what payrolls really did, and the expectations are minus 450 to minus 750,000 for over that entire period. So that would show even weaker payroll employment. But again, wouldn't that imply that productivity needs to be revised higher? So let's not forget the productivity story because that seems to explain a lot. Meanwhile, as I said, in the labor market, I'll probably be the last baby boomer still working for a living. I really enjoy it. Keeps my mind going, though every now and then I get these moments. But here you can see the baby boomers. The oldest ones turned 75 here, 65 back here. They're now 79 years old. I am 75 going on 76. I know I don't look it. I look like 20 years younger. But you can see that baby boomers are dropping out. These are very experienced people. It's not very easy to replace them with people coming out of college who have no experience. And maybe you take the labor force you have right now and try to replace the baby boomers by keeping the adults in the room that aren't seniors and augment their productivity with technology. So as I said, the teenage unemployment rate is very high. The college, the people, not everybody in 24 years old has a college degree, but they are having a tough time finding a job. And then, as I mentioned, here's health care and social assistance. That might be related to what's going on with migration. Here's another one for you, state and local governments. This is education and ex-education, and that might have to do with migration. Fed can lower rates, but that's not going to change the fact that state and local governments don't have to hire workers. So that's kind of the good, the not so bad, and then there's the relatively ugly, and I don't have time to get into it, but we all know that there's some debt crises brewing abroad in the United Kingdom and in Japan and in France, and we'll be covering that to see if that might spill over. Oh, I forgot to tell you, I wore the company uniform today. I got tired of promoting the alligator. So let's see what we got here. I think we got one question so far from Michael, which we can handle one question because I've kind of run out of time anyways, and I appreciate that you're all sticking with me here. Did you just say you were expecting a recession in 2026? I don't think so. At least I might have misspoken, but no, I do not expect a recession in 2026. I'm not expecting a recession for the rest of the decade. I'm talking the roaring 2020s, baby. And if the roaring 2020s works, I've already been talking about the roaring 2030s. This is kind of like just an extrapolation of the digital revolution, creating a whole new economy that we're all going to have to kind of reassess and there's Max. Max is reassessing. Max, market going up or down? Let's see. Will Max go up? He's not. I don't think he's going to tell us. Okay, or that. Yeah, I know. I said I'm expecting poly markets will have that question. Okay, another question came in. Hey, Ed, thank you for the update. Do you think there's a chance that never-ending bull market is masking monetization issues with AI? Yeah, I think it is what it is. I mean, the earnings have been great, which to me means that the productivity numbers are probably better than people thinking. Profit margins seem to be hanging in. They're actually going up, which suggests that productivity is doing quite well. American companies are just, they're the best in class. I mean, there's great companies overseas, but our businesses are run extremely, extremely well. and our capital markets allow for a tremendous amount of restructuring of companies, mergers, acquisitions. Um, America is exceptional when you look at what it's my mantra that I've learned over the years is, isn't it amazing how well the U.S. economy and the stock market do despite Washington? Just kind of repeat that to yourself 5 times every morning, and all will be well. Gary, any opinion on where 10-year goes after 25 bips rate cut? I still have this hang up with that the normal rate bond yield should be 4.5% plus minus 25 basis points. And it looks like it's going to retest 4%. We're just right on top of that. Maybe we'll get down to 3.75%. We've been there before, about a year ago, and then it bounced right back up. So I'm thinking I'm not going to predict that we get down to 3.75. We could get, a bit under 4%, but I think it'll bounce back. Hi, Japan, UK, and France. Likelihood that it is the tipping point. Well, it could be the tipping point for them, but maybe the UK will demonstrate that when the bond market scares the politicians, they actually do something. But or then they may not. We'll see. I think it'll be sort of a test, kind of lab test for the rest of us. But clearly, the debt crisis concerns are still out there. The Bond Vigilantes went on vacation, didn't like what they saw in Japan, UK, and France. Lovely tourist sites, too many tourists there in all of them. But the Bond Vigilantes are alive and well, just not in this country right now. They don't seem to be particularly fazed about inflation. They're really focused more on the Fed cutting rates because the labor market looks weak to some. Max went back up. Oh, good. Thank you. Yeah, that's a good point. One last one. Good morning, Ed. On the political front, are there any consequences for the banks with regards to all these public figures deeming multiple properties as their primary residences? I only have one. I'd make a great Fed chair because I only have one. I have a very small mortgage. So if that's the criteria for being at the Fed, actually, I really like doing what I do. I like working with you folks, so I will not accept a Fed position, especially since I would insist on working from home like this, and I'm sure that wouldn't be allowed. But no, I don't think. I think it may have some impact on the banks being much more careful about the loans they make and making sure that people are aware of the consequences and penalties of lying in a mortgage form. But I think this opens up actually a can of worms because my hunch is that at least half, if not more, of politicians in Washington and people that every 4 years we have an election and maybe we get a kind of a turnover from Democrats to Republicans every 4 to 8 years. And so people from out of town have to come into town. Many of them want to live in a house they own. And so they cheat. They say, hey, this is my full-time residence. Meanwhile, they keep their full-time residence at that ranch in Montana, and they've just broken the law. So I'm sure I think there's some rule that, you can send just about anybody to jail if you really start to investigate their personal life and their financial life. And that seems to be what's going on now if you accept a position at the Fed. So I'll have to look back in my past and see if they can get me on anything else. Anyways, no, I'm not going to take an offer if it's given to me, but so far it has not. Well, on that note, let me thank you very much for tuning in, and let's do this again next week. All the best.